All right, good Thursday afternoon, traders, investors, Finom group members. As you can see, tailwinds and headwinds, kind of the focus here this week as we've had a lot of headwinds coming into October, but October, the first week till today, we've basically seen a lot of those headwinds dissipate. Right, a lot of that negative energy dissipate, positive energy that began in the first week of October has lasted. It certainly has lasted. This quote here kind of welcomes us to our new weekly state of the market. The speculator fights his own good sense, struggles against his own will, and is at odds with his own decisions. There are many occasions in which every speculator seems to have two bodies, so that astonished observers see a human being fighting himself. That quote comes from Joseph de la Vega. Like, who wants to be that guy? That just doesn't sound, like an appetizing way, or an appealing way, I should say, to participate in markets as a speculator, as a contrarian investor, at odds with your own decisions, fighting and struggling against your own will. Just doesn't sound like a good idea, does it? All right, with that, let's jump into things. A little bit of a review from last week. Recall this study, this chart, the upper Bollinger Band, S&P 500 finishing above the upper Bollinger Band, finishing higher 6 days in a row as of Thursday. With 7 days in a row as of Thursday. Going into Thursday last week, and during our state of the market, we were up 6 days in a row. For the third time this year, we've done that. We did wind up higher on Thursday, so we were actually up 7 days in a row. Friday, we had a little bit of consolidation. But 5 days later, every time that we've had a 6-day rally here this year, 5 days later, the market was higher each time. So last Thursday's close was 4,549. So essentially, we have to be higher than that 5 trading days later, which is today, this Thursday. We've got to be above 4,549 on the S&P 500 to keep this streak of 6 positive days in a row. The market is up, and then 5 days later, the market is even higher. So again, here was the 21st last Thursday. There's the closing price, as you can see off to the left side of my screen, 45.49. Here we are today, 40 points higher at the moment. I say that because most people realize what happened in yesterday's trading session from about 2:30 to the closing bell. We were up a good 8 points in the S&P 500. We were up 120 points in the NASDAQ. By the closing bell, the NASDAQ was up less than 1 point. And the S&P 500 was down 23 points, which essentially took the market basically flat. The S&P 500 was only up like 7 points for the week after that 23-point drawdown yesterday. Very choppy price action. Very choppy price action, folks. All right. So again, we finished above the upper Bollinger Band last Thursday. Remember this study here, S&P 500 finishes above its upper Bollinger Band 44 times since 2017. The average return, 0.25%, 5 days later. So we came into the week at 45.45, I think. Let's check it out one more time. That was Thursday, so here was Friday. 45.44, almost 45.45. And we're at 45.89. So we're up about 1%. We're actually, as of right now, outperforming this study. But what the study, lent itself favorably was the percent positive rate. 63% of the time, the market was higher 5 days later and after it closed above its upper Bollinger Band. 63% of the time, the market was higher. And indeed, right now, on Thursday, 5 trading days later, we are higher. Now, having said that, this chart from Bespoke Investment Group, S&P 500 performance percent went up 5% or greater than 5% month to date with just 3 trading days to go. So that was Wednesday, Thursday, and Friday. We have 3 trading days to go. And indeed, we are up more than 5%. Whoops. We're up actually 6.2% month to date as of the start of Wednesday. Okay, so even if you include today, we're probably pretty close to being up 6% on the month. And that marks the best performance through the final 3 trading days of any month since last November. Again, funny how history repeats. Remember, the top in the S&P 500 last year was September 2nd before it went through distribution. The top in the market this year, September 2nd before it went through distribution. Last time we had a monthly return, month to date, of this magnitude was last November, when the S&P 500 was actually up 11.2% month to date. Remember, that was an election year. We had the nice drawdown before the election, and then election week came and it was off to the races last November. In the post-World War II period, there have been 95 occurrences where the S&P 500 was up 5% month to date, heading into the final 3 trading days of the month since World War II. In those prior months, the S&P 500 has averaged a gain of 7 basis points in the final 3 trading days, which is below the average gain of 22 basis points in the final 3 trading days for all months during that same time period. It basically begs to respect that we pulled a lot of returns forward through the month. And so within the context of just having 3 trading days left in the month, don't expect a whole heck of a lot. But the end of October and early November are historically quite strong, right? We talked about this monthly calendar of S&P 500 returns by the calendar date going back to 1950. Here we are in October. And as you can see, this date right here, the average return, 0.46% on October 28th. That's today, folks. It's one of the best S&P 500 return days of the year. I'm looking at November 23rd and December 26th, the day after Christmas. Those are the 2 absolute best returns of the year by calendar, going all the way back to 1950. But this day right here, today, October 28th, is typically a very good day for S&P 500 returns. Now, coming into the week, we were also looking a little bit deeper at some of the historical data regarding October and the final 5 trading days of October, which is this week. This is it. Monday through Friday. We come back next week and we start the November trading calendar. And what we found out is during the first year, year 1 of a new presidential cycle, that's what all this data here was from the weekly research report. The final 5 trading days of October, the average gain is actually a loss of 0.57%. But the market is actually up more often than not. 61% of the time the market is up. It's not a small sample. We're going all the way back to 1929, year 1 of a new presidential cycle. The last 5 trading days of October is actually more often than not positive, which in order to have an average return that's this negative, tells you there's some big down final weeks in October. And more than likely, the data is skewed by maybe the 1987 crash, maybe, of course, the dot-com era and the great financial crisis basically kicked off in October, of 2008. Last year, the final week was horrible. We lost 5+%. I think 5.6 or 5.8% in the week leading into the election, which was the last 5 trading days. So, those nuances, those specific calendar years really added to the negativity of average returns for the final 5 trading days. But more often than not, So this week, so far, so good. So far, we're up about 1% on the week. But anything can happen after hours here. It's earnings weeks, folks. So far, the market has skated pretty well through earnings. What this data right here is, the 5 largest stocks in the S&P 500 with a combined market cap of $9.23 trillion, representing about 22% of the S&P 500, are reporting earnings this week. It's basically the big 5, Amazon, Alphabet, who else? We got Apple, Facebook, right? So we've got the big 5 reporting here this week. And typically when they all report in the same week, not good. It happened in the last time they all reported in the same week was this year in July. The market was down. Before that, April 26th, flat. There's some really bad weeks in here, folks. Down 5.6. See, October 26th, that was the week before the election. April 27 of last year, the week of 2018 and 2015. These were the previous times that the big 5 companies all reported in the same week, and this was the S&P 500's performance for that week. So if we actually do carry through these gains that we currently have through Friday's close, it would be an outlier, obviously. We do have Apple and Amazon reporting after the closing bell today. So we'll see what happens. We will see what happens. Keeping in mind that not only is today one of the best, S&P 500 return days of the year, but we have been talking about the first 2 trading days of November, going back 31 years. The first 2 trading days of November, if you had bought on November 1st and sold on November 2nd, even if you sold at 3:59 p.m. Eastern Standard Time, you had a winning trade. Going back 31 years, 31 trades, all 31 times the S&P 500 positive return. So Friday, tomorrow, the 29th, maybe we do get a pullback. Maybe they sell Amazon. Maybe they sell Apple, and maybe that, kicks off the Alphabet going down and Facebook going further down, and just the mega caps weighing on the overall S&P 500 and NASDAQ. You might think about buying that dip. Assuming that the fundamentals are strong with these companies when they do report, and it's nothing more than profit. I mean, Apple's running into the earnings release, Amazon's running into the earnings release. You just never know. That's why it's important to pay attention to what these companies report, so that if they do consolidate and bring the indexes down with them, consolidating at the index level, you know what to do. If it's just normal and to be expected price consolidation off of good fundamentals, that's a dip you want to buy. And this is the data that helps us with those probabilities for November, the 1st and 2nd trading days of the new calendar month, November. All right, we came into this week overheated. Like, how many times have I said that? You don't want to chase a market that's overheated. You want to ride through it with your core holdings, your long-term holdings. If you find those opportunities, because not everything's going up. There's going to be weak sectors, weak industries where you can, buy dips early on and benefit from the overall strength of the market, pulling things higher. But indeed, we showed this chart last week or on our weekly research report. And as it says, the final, let's recall that some 87% of S&P 500 stocks, 87%, were trading above their 10-day moving average at the beginning of this week. Right? That's one of the faster moving averages. That's how strong the previous 10 trading days has been, right? You had a 7-day win streak, a 4-point consolidation last Friday. We picked up where we left off on Monday and Tuesday this week. The market went higher up to 45.98, new all-time highs. Like the strength just kept, finding more strength, more momentum, new all-time highs. So we got even more overbought. This chart right here is just all the different sectors and their 10-day advanced decline line. We made a new all-time high in the S&P 500 cumulative advanced decline line. We made a new all-time high in the NYSE cumulative advanced decline line. Like, breadth was just so robust, folks. But it creates these overbought conditions, not just at the index level, but at the individual sector level as well. The 10-day advanced decline line measures the average daily number of advancers minus decliners in an index or sector over the last 10 trading days. It's a short-term breadth measure that traders use to measure how extended the market is at the moment, overextended, overheated. Very high readings, like we do have now, suggest that the market might be overbought in the near term and downside mean reversion can be expected. Very low readings suggest the opposite, that the market might be oversold in the near term and upside mean reversion can be expected. All right, now even though we're overbought, overextended, you can see that the momentum is just carrying through. Earnings season has been really strong. But don't discount some kind of price consolidation, here in the final, what's going to be the final 2 months of the trading. Don't find yourself without, some measure of risk management, some measure of, like I always say, I like keeping low expectations and let the market overachieve it. I'm more than happy to see the market overachieve it. But if I set, low expectations, I'm no worse for wears. The market's not going to hurt me. I got my game plan. I know what I'm going to be executing, buying on the dip, buying cheap, buying value. This study that we've highlighted many times in the past tells us what the possible maximum or average drawdown is here in the back half of the year, after we have had a 5% pullback in September. The Q4 drawdown from the first half peak, the average is 3.87%. We've already had the 5.2% drawdown in September. Like that's where we found our trough and elevated here through all of October now. But you never know, we could have another one. Next week is the FOMC meeting, keep in mind. Just don't forget your studies. Don't forget this quantitative data because it helps you with the probabilities. And you want to lean into these probabilities. The S&P 500 is currently up 20+% going into Thursday's trading session. The index may finish the month of October with trailing 12-month returns greater than 20. It will. Remember, this goes all the way back to last November. Last November we were up 11%, plus 20. Like we're up, 30+%. Like we're going to qualify here. So this quantitative study by Steve Depp shows that the index has done following every other October that finished the same way, meaning plus 20% basically over a 12-month period. The market was higher 12 months later, 83% of the time. I guess what's most important to us, though, is the forward 1-month return. And again, you're looking at almost 90% of the time the market was higher. Right? We're going into November, folks. It kicks off the best 6 months to own stocks. Man, 90% of the time the market is higher. Look at the average return. The average return is not the median tree. You want to set low expectations. Take the median return. That's still strong. 2 months later, up 5.44%. And 5.57, and almost a 95% positivity rate. Objects in motion tend to stay in motion. Strength begets strength, and we are heading into the strongest seasonal time period of the year for S&P 500 returns. Kicked off this weekly state of the market talking about headwinds and tailwinds. Right? And all we've heard throughout the course of this year, we kicked off the year with peak lumber, right? Lumber prices just skyrocketing. So peak lumber, and it's peak oil, peak supply line bottlenecks, peak used car prices, peak bond yields, peak chip shortage, peak natural gas prices, peak. Peak headwinds, like these are all types of headwinds. For the economy, for the market, for earnings. Peak headwinds, they tend to resolve in favor of tailwinds. Your headwinds from the past become your tailwinds for the future. Have a peek at yourself for the data. The real risk. Let's talk about the real risk for individual investors, right? You, me, the average investor. The chop, market mayhems, flash crashes, Wall Street gibberish, volatility, and a myriad of economic troubles presented with ample media garnish is not risk. That's noise. They are normal. That's what you expect from the media, from Wall Street, from the markets, the chop, the volatility. If that's not what you expect, you're in the wrong business. That's just normal. The patient investor wins over time, right? We're talking about the real risk. The patient investor wins over time. The impatient very often sadly lose. The impatient very often sadly lose. The real risk? Time. That's what we're talking about. The patient investor wins over time. So the risk to the average investor is they don't give themselves enough time. That's the risk. You know what the market's going to do over time. It's going to go higher. The volatility is supposed to be expected. Wall Street's nonsense, trying to explain why price is doing this and price is doing that. To be expected. Flash crashes here and there, to be expected. Choppiness, to be expected. Give yourself time. And that's the real risk that an investor has. They don't give themselves enough time. The time it takes to plan, review, stay on the track of your goals, and the time it takes to recognize something frustrating but true. That staying the course works better than concerning yourself with all the benchmarks and meanderings. Sometimes the biggest risk to your investment is you. You're not willing to take the time. All right, let's talk about some breadth here. We got down to 0.92, right? This is one of our favorite breadth metrics. The New York Stock Exchange, stocks trading above their 200-day moving average relative to the percentage of stocks trading above their 50-day moving average. Remember, when the line is going down, interim breadth is strengthening. When the line is going up, interim breadth is weakening. We got down to the lowest. Here's 2021, folks. We got down to the lowest level on this breadth metric just earlier this week. Interim breadth just has not been this strong all year long. Again, we made all-time highs in the indexes, in the advanced decline lines. There's not much you can do here. Again, ride your core holdings into this. If there's opportunities to trade, take them if it's within the context of your game plan. If you can also use this as an opportunity to rebalance your portfolio. Maybe there are some areas. You've hit your price targets. You've hit your investment goal for this stock or this ETF. Execute, take your plan, rotate that capital somewhere else. But you do want to be rotating that capital somewhere else because the strength of breadth is telling you. The market is in good shape. NYSE new highs minus the new lows. So within the S&P 500, you have a percentage of stocks making new highs. You subtract that from the percentage of stocks making new lows. Apparently, there are a lot more stocks making new highs than there are making new lows, which is also why the NYSE cumulative advanced decline line made new highs last week and another new high this week. Not much we should be doing, as positive breadth is largely inactionable. Our greatest activity should come when breadth and price are weak, right? Buy on the cheap, sell when things are ripping, to benefit from the reversion to stronger breadth and resumption of the uptrend. We should be more taking advantage of weak price. Our greatest activity is when price is weak, not when price is strong. The New York Stock Exchange advanced decline line, you can see here, breaking out. Again, when this happens, there's momentum. Index investors can breathe a sigh of relief. If you're an index or an index ETF investor, when the NYSE cumulative advanced decline line is sitting at record highs, you can take kind of a breath and say, things are going to be good. I should expect additional gains. But also, the drawdowns are like a full-blown correction is rare. Like a 10% textbook correction after you've made or you're just making new all-time highs in the advanced decline line, usually the declines are less than 10%. New highs in the NYSE AD line have consistently preceded stock gains since 1928. Preceded stock gains since 1928. We make a new high, and then usually there's higher highs in the indexes. Over the next 3 months, there were no losses since 1928, greater than 8.5%. Why I said we typically don't have a 10% correction once you are, or you're just making new all-time highs in the NYSE advanced decline line. On average, drawdowns were limited to only 1.6%. We good? We good here? All right. Good stuff, folks. Here's another, we're talking a lot about the NYSE. NYSE performance 20 days after this signal here from market charts. The percentage of NYSE stocks declining for 5+ consecutive days was at just 3.6% as of Wednesday's trading session. That is an extremely low number of stocks that are trending down for 5+ days. That is how strong breadth has been, folks. Before, of course, the intraday reversal on Wednesday. This breadth strength over a 5+ day period has happened 45 times over the last 5 years. So it happened a lot, as shown in the bottom chart here of the NYSE. 20 days later, when you've had breadth this strong in such a low percentage of stocks trading or downtrending, 20 days later, the average NYSE return was 1.3%. Right, the 20 days, 22 is the average calendar month of trading. So if you're thinking a little bit longer term, we're going to want to review this study come the end of November. Are we 1.3% higher on the NYSE? Percent positivity rate for this particular study, 73% of the time was positive over the last 5 years. So act on local price weakness when the market presents the opportunity, but think with the longer term time horizon. So if we get some kind of pullback in between now and the end of next month, end of November, this study says you should have been buying that dip. Remember this guy, David Hunter, right? We talked about him and his market crash call. He's out with another call recently. The bond market rally has begun. I continue to expect the 10-year yield to drop to 1.35, 1.4% before it begins the march to 2.5%. I suspect an equity market sell-off along with a rollover in oil prices will help push rates lower. Nothing new here, just a reiteration of my view. He's basically, the S&P could fall 4 to 6% and the NASDAQ a bit more. If you don't remember his call, here's the link, David Hunter. I think we did this in July with David. David calling for a market crash in July that did not materialize. All he does is call for more. But speaking to his bond market call, right? I don't think there's research. I don't think there's quantitative and seasonal data that supports his thesis either in the bond market. This is the seasonal factor when it comes to yields, rising and falling. And October is the best month. And indeed, the 10-year yield will finish higher for the month of October. It usually is higher in the month of November and December as well. So when you look at, this seasonal data doesn't support David's call in the bond market, and really none of our quantitative studies support his thesis for the equity market either. But the FOMC meeting next week, right? You never know. You got to keep an open mind, be flexible. Even though the S&P 500 settled back a bit on Wednesday and has chopped around lately, most of the stocks in the index have gained ground. That has been enough to give us a new all-time high on the cumulative advanced decline line for the S&P 500. Stocks are less likely to suffer a large drawdown in the following months when the AD line breaks out to a new high, which it just did. Since 1928, just like we were looking at in the NYSE advanced decline line, we're going back to 1928, the S&P 500 was 3 times more likely to suffer a 10% decline at some point within the next 3 months if the advanced decline line was not at a multi-year high. When it did break out to a new high, there was only a 4.6% probability of a 10% or greater decline within the next few months. It's a really low probability, folks. All right, we're heading into November, right? November has been strong historically, no matter how you look at it. Post-election years, past 10 years, past 20 years, since 1950, that's all wrapped in up here. Like, it's got the highest, win percentage. It's got a high return percentage rate, better than any others here so far as the clusters. Any conditions we're looking at, these candle clusters are better than any other month. Here, the November, December, and January constitute the year's seasonally strongest 3-month period for the S&P 500. So now if we take it beyond November, and we're looking at November, December, and January of the new year, that's the 3 strongest month period. The 3-month period is the strongest of any other 3-month period of the year. Here it is with the S&P 500. As you can see, November through January. Yellow candle there. November through January for the NASDAQ, the yellow candle there. I've given you a lot of information to digest so far as the indices, so far as the stock market, right? Probabilities, our historical data, our seasonal data. What we haven't talked about a whole heck of a lot is about the economy, right? Because we did slow down in Q3. What I've been heralding, if you will, writing about in our weekly research report is I think we should see a re-acceleration of economic activity. Today, we got our first look at the Q3 GDP, and it came in at 2%, which was under economist expectations of roughly 2.5%. Depend on who's doing the survey, if you will. But we want to see it in retail sales firstly. Like if the consumer's spending money, if they are increasingly spending money in retail sales, the economy's going to do just fine, folks. And we are seeing a continuation of strong retail sales here. Here's the Johnson Red Book, the latest update this week, retail sales on a year-over-year basis up 15.6%. People just got their check here, their child care tax credit that goes out every month until the end of the year. And every time they get it, we see a spike into the end of the month. And then we see a drop off in the new month until we hit mid-month again, and it accelerates. It's a consistent pattern surrounding that check. But the fundamentals are improving in real time, folks. Did you see new home sales this week? Man alive. The rolling 7-day rate of new COVID cases has fallen over 60% from its peak in early September. Now that's a good peak. Peak. No doubt connected to the decrease in cases. Jobless claims have fallen steadily in recent weeks, with continuing claims sliding below 2.5 million for the first time since the pandemic began. People are they're going back to work. Like, this is what we've been waiting for. Everybody, well, when the stimulus runs out, when fiscal policy is tightened, that's when things are going to get crazy. Everybody gets wrapped up in the moment. They were fixated on the normalizing economy in Q3. Like, that's the way it was going to stay. I think a lot of what we see in social media and financial media is, the data comes out and that's forever data. It's not. If there are problems in the economy, we overcome them. They're momentary lapses that find reacceleration. The media wants you to, they want to suck you into this narrative that, jobless claims staying elevated, non-farm payrolls not producing enough jobs on a monthly basis is a forever situation, and it just isn't. Based on what we've seen in the last 3, if not 4, initial jobless claims reports, I think we can finally see a really strong non-farm payroll report come next week. Next week is jobs week, folks. Get the ADP, you got jobless claims, and you got non-farm payrolls on Friday of next week. And it just so happens to be an FOMC meeting week. It's going to be a little hectic next week, possibly. You got to put all those variables together. It could get a little wild next week. And think forward. We all have to be thinking ahead of the market. Projected holiday sales here from Wells Fargo. They're looking at it from every angle. Holiday sales. The worst that it could be, according to Wells Fargo, is 8.6% year-over-year growth. No wonder the National Retail Federation says they're expecting holiday sales to grow 8.5 to 10.5%. That's huge, folks. That's a massive growth. It speaks to the pent-up demand. It speaks to a healthy consumer balance sheet. It speaks to a healthy economy. I get it. We slowed down. We had issues with COVID during the third quarter, but those issues have subsided. Could they flare up again? They could. At the same time, we've got an answer for at least part of that, which is every day we have more people getting vaccinated. And now we've got FDA approval for a children's vaccination under the age of 12. Don't get me wrong, and please don't politicize this. I'm not saying I favor or I don't favor, when it comes to kids. I'm just delivering you the facts, okay? And more than likely, there's going to be more than one child that gets vaccinated. To my point, there's more people that are vaccinated. So we have less likely of a chance of another mass, flare up from a new variant. That's all I have, but I want you to check out this Rising Yields, Rates, and Market Returns by Merrill Lynch. This is their latest report. Some really good notes in here, folks. I hope you're having a fantastic October. After the closing bell, we've got Apple and Amazon. Stay nimble, stick to your game plan, and if you have any questions, you all know where to reach me. Send me a direct message at any time. This week is our off week when it comes to research reports. Next week, we will not have one either, I'm afraid, because I will be in travels. But we will pick things up again in the second week of November. We will have third-party research as well. So don't worry. We will have the state of the market next week also. But for the next 2 weeks, including this weekend, we won't have weekly research reports. With that being said, don't forget to read this Merrill Lynch. Go back through the notes, folks. And if you have any questions, don't hesitate. Send me a direct message at your leisure. Have a great trading day and great trading month come November.